We're thrilled to be hosting this special event on the topic of financial security and find out what we need to know to bridge the gender investment gap. In the UK, reports show that only 1 in 5 women are investing versus 1 in 3 men, and this is putting women at a financial disadvantage in the long term. In fact, in the UK, on average, women retire with just a quarter of the amount of money that men do when they retire, which is why it's essential for us to be clued up on investing. Next slide, please. First of all, to our new joiners, let me give you some background to who we are and what we do. Women at Tech UK was founded in 2019 in an effort to give back to the community and now has 10 members, including Amazon, BT, Cisco, Colt Technology Services, Meta, Google, McKinsey, Salesforce, and Uber. We're committed to raising the impact of gender equality initiatives in tech companies in the UK. Next slide, please. Women at Tech is a collaborative community that shares best practice and innovation and insights on an ongoing basis to help our member companies achieve more gender equal workplace. After our event on the Broken Rung last summer, we're thrilled to be kicking off 2020 with this event on financial security and welcome our guest speaker Aysha van der Paer. Next slide, please. Aysha has over a decade of professional experience in investing for established investment and consulting firms around the world. Having worked and studied in New York, San Francisco, and Zurich, she's a gender advocate who has made it her mission to help women become more confident investors while investing in a way that supports the planet and society. So without further ado, I'm going to hand over to Aysha. Welcome.
All right, thank you, Sophie, for this kind introduction. I'm really glad to be here with you today, and I suggest we dive right in. All right, so today, as mentioned, I'm here to talk to you about investing in your financial security, how to bridge the gender investment gap. Maybe just a couple of words about me. I'm an investment professional. I've been in the financial world since 2002. I spent many years in real estate and private equity investing around the world. I'm a single parent of 2 boys. I live in Zurich, Switzerland since 2014. I'm originally from Switzerland, but I spent before that about 10 years abroad. And I offer a step-by-step program to learn exactly how and where to invest and make it fit the specifics of your international life, including international pension planning, tax matters, currencies, etc. So I've spent about 10 years abroad. As mentioned, I lived in the Netherlands, I lived in Dubai, I lived in Munich, I was 4 years in New York. So I'm also familiar with all the US expats issues and difficulties in investing. One of my sons here, he was born in New York, so he's American. So I've done a lot of I've dealt with this matter quite a bit with US tax filings and all the restrictions that comes with investing as a US citizen living abroad and specifically living in Europe. All right, and I want to say you're in the right place if you are an expat or a resident in Switzerland or Europe, and by Europe I still mean the UK, it's geographic Europe. If you're very busy, you've already got way too much on your plate, and you should kind of look at your money, saving and investing, but you don't really have time to learn about it and deal with your investments on a day-to-day basis. And maybe your priorities are changing. 10 years ago, this topic was not really on your radar, but now somehow you feel the need to get more serious about it. And also you might feel a little behind into organizing your finances. You might feel you're a bit in the dark, especially if you are an expat and living in a different country. You don't really understand how what are the rules and regulations of the country you're in now, where you're going to go in a few years, etc. And you want to stop worrying about money and basically about the fact that you might not be doing what you should be doing with your savings and investments. This is not for you. However, if you're looking for trading tricks on how to make a quick buck and, you know, having tips on buy this now and sell this now, this is not what I do. I'm all about the long term. And also if you're in money troubles, although given where you work, I doubt this applies to you, but, you know, this is not, you know, I'm not about teaching how you can fix a difficult situation in the short term. It's more about, it's all about the long term. All right, I also want to say stay tuned until the end because I am gonna talk a little bit about a few of the platforms you can use to invest the right way and in a way that's very time efficient. All right, so now we have our first poll. I would love to see where you're based, where you're, you know, a resident or where you live. So if you could, I think Sophie will launch the poll. If you could answer it, and then I can also a little bit tailor what I'm saying to make sure it's fitting, you know, where you guys are based. All right, so we're going to take a couple of seconds until people are done voting or polling, and then we're going to take it from there. All right, so I think we can slowly start sharing the results. Let's do that and share the results. Okay, so we see we have a lot of people in the UK. That's good to know. A few people in Germany, France, Spain. All right, and some people who are scattered in other places. Okay, so let's keep going. Perfect. All right. Now let's talk about the problem. We have a bunch, how many? 328 or 29 of you, of very well-educated women and a few guys, I guess, who have a very good job, but who are not investing or investing very little, or you have received your company shares and they are sitting there and you don't really know what to do with it, okay? And so why is investing so, like, you know, proactively looking at investing and investing more than your company shares, for example, so important? Well, this is because, as we know, as women, we're at a financial disadvantage. We are typically paid less, we're promoted less, we take some parental leaves or part-time work to care for children later on in our lives, or aging parents. And also something that was very applicable to me, I was adapting my career to my husband's career. So that's why we moved around the world. And so he had like a straight up career, and mine was more of a roller coaster because it was not always easy to find the right opportunity exactly when we were moving for him. So because of that, because of all these aspects, it's very common for women across the Western world to retire. On average, women retire with 40% less in pension capital at retirement, okay? And, you know, that's an issue, obviously, by itself, especially given that there are about 50% of divorce rates across the world. And on top of that, like if it was not bad enough, women live longer than men. We live 5 years longer. So basically we have less, much less, but we need more because we live longer. So that doesn't work so well. And so that's why investing privately on your own account is the only way women can achieve financial security when they get older. And I really want to insist on that the problem is the problems usually don't come when we are, you know, still, you know, 20s, 30s, you know, and even 40s. They really come later when people get, are divorced, when we start looking at retirement, when there is not so much time anymore to kind of catch up from a financial point of view. So that's why the earlier we kind of look at this topic, the better prepared we are once we get older. All right, and it's not what there is to it. There is much more to it, actually. You know, a few years ago, I met a few people, including Paer here, who really kind of changed my perspective on money and investing, because until that time, I was really in the financial sector, a little bit like you see on TV. It was all about making money for investors, for clients, optimizing taxes, really investing for profit. And that was all that we cared about. And then when I met her, she said something that really, struck with me and changed my perspective. She said, when we have money, we have a responsibility towards society and the planet to invest for a positive impact. And this really stayed with me. She thinks like we have a responsibility towards the planet. We can invest, in support of climate action, for affordable and clean energy, for responsible consumption and production. And we have also a responsibility towards society. We can invest in a way that we support companies that are scoring well in terms of gender equality. We can support access to education, decent work conditions, etc., etc. Now, obviously, the more money you have, the more specific you can be in the positive impact you're trying to achieve. And the less money you have, the more you kind of going into this kind of general sustainability criteria. And now I want to say a few words about my story because it kind of illustrates a little bit all what I've just said. So I have 2 college degrees, like many of you, I'm sure, and I always wanted a rewarding career that would give me financial independence. And if I flash back to 2012, I was 31 at the time. And at that time, I was following my husband around the world for his career, like I mentioned, which meant my own career and earnings were like a roller coaster. And after the birth of our first son, combining a rewarding career and family responsibilities and moving around the world for his job became a real challenge. And so I knew back then that I needed to sort out my personal finances and invest to grow my money, but somehow I felt so overworked. I was so overwhelmed that I could not find the time to make it a priority. And so my journey with investing, I did start investing when I was a teenager, the regular way at a traditional bank. It was terrible. And after a while, I stopped and I didn't invest for a long time. But here, if we flash back to that time, in April 2012, I had just become a mother and I was desperately looking for a new job in New York. And then fast forward 2 years, I was working again, but I was earning 25% less than before. And I was following my husband's advice for my investments at that time. And he was in investment banking in New York. So it was really, a lot like, oh, buy this now because they are undervalued and they're going to announce something probably. So then the share are going to go up. And then like 2 weeks later, he was like, oh, now, sell it now, sell it now. So it was like this kind of investing. And, I thought, well, he knows what he's doing, right? So I was kind of following his recommendations. But at the same time, this didn't feel quite right. I didn't quite like it, investing this way. It was really not what I was looking for. And so I really took to it and started really investing on my own accounts in companies that I believed in more for the long term. And by December 2016, my portfolio included countless individual shares at Credit Suisse. I was back in Switzerland and I was working for a subsidiary of Credit Suisse. So I had to have my portfolio there, but there was no clear strategy. It was very random, and especially it was expensive and unmanageable because when you invest in a lot of different shares, you pay a lot of transaction fees, and it's very hard to have a balanced and well-organized portfolio when you have a lot of individual shares. And then in March 2017, something really, really terrible happened. My husband, Carl, had a road accident and he died very suddenly. And at that time, I was expecting our second child. So as you can imagine, very, very difficult time in my life, very, very big shock. I was pregnant. So it's like this drama story you can imagine. It was very hard for me. It was very hard for our oldest son, who was 5 years old at the time. It was very hard for his parents. He was an only child, all of family, etc. So it was really terrible. And the reason I mention it here is because very quickly, all the financial issues started, many financial kind of topics or issues started getting a very important topic. And you will be surprised how fast this becomes something that you need to care for after something terrible like this happens, as in like 2 days later, you have to start making decisions. And, all of a sudden, my husband's large income was gone. All of a sudden, I'm a single parent, and I have to support and pay for childcare for 2 young kids. And here in Switzerland, childcare is not really subsidized, so it's very expensive. And then that's something I never thought about and never cared about, is that because we live the expat life, we get reduced survivor benefits. So, like social security benefits for widows and orphans, right? Because it's very hard to qualify for anything or for much when you spend 2 years here, 3 years there, 4 years here, etc. And so, now the reason I also want to mention that is because, you might be thinking, oh yeah, but this never happens. Well, it does happen sometime, I can tell you, but luckily not to everyone. But what does happen to everyone is retirement, and actually the benefits, the social security and pension benefits, they come, it's the same mechanism. What you get money when you are like an orphan or widow, you get some allowances from the pension funds and from the social security system, and it's the exact same places and mechanism for when you retire. And so all of that to say that what we don't realize when we move from one country to the other is that we are making inconsistent and short time contributions to different systems, and that mean often that we don't qualify for anything or much when we come to retirement. And then it's very easy to get a bad surprise at retirement time, because first of all, we have no idea where we stand, and secondly, we see we don't get as much as we thought we would. Okay, so then in October 2017, I decided to tackle my finances head on and use investing to achieve financial security rather than just trying to make more money and have fun with it. And then in January 2018, I started to revamp and simplify my investment portfolio. This is very important, simplify, because we tend to think that the more money we have or the more experienced an investor we are, the more complicated our portfolio should be. And that's actually really not true, quite the opposite. And then a year later, in January 2019, I transitioned towards sustainability investing. And now I have an investment plan that works for my specific situation, having lived in different countries, having a son who is a US citizen, etc., etc. And I've implemented it and I stick to it. I've moved my money to 3 cost-effective investment platforms, and I have a system in place to invest automatically every month. And thanks to my investment setup, my money is steadily growing over time at an average annual rate of 6% plus. Now, these 6%, 6.5% plus, these are average stock market returns. And that's what we can expect over time when we have a well-diversified investment portfolio. Now, to be honest with you, in the last few years, my portfolio grew by much more than that because these were very good years in the stock market. All right, and I invest in alignment with my values, which are gender equality and climate action, and it just feels right. And now I have another poll for you. I would like to know if you already invest. And so do you already invest? And here we're not talking about whether or not you have company shares. Do you invest separately from your company shares on your own account? All right, so we take again a few seconds to let you guys participate in the poll. Okay, so I'm gonna end the poll and share the results. There you go. So we have, so majority of people say not yet, about 50% of people, and then 38% who say yes, but only a little. So this is very typical. And then we still have a few people who actually been investing for a while, which is great. All right. So let me move on. Now let's get to the interesting stuff. So first, rule number 1, which basically comes from Warren Buffett. He says, rule number 1, don't lose money. Okay, and how do you do that? by investing for the long term. So let's look at that topic. So first, what might be holding you back is to think, oh, investing is too risky. I don't know enough, so I will mess it up and lose money. Or I know so many people who lost money on the stock market. I think we all have kind of these stories that come from our youth, where we heard, oh, this person, they invested in the stock, in some shares, and then the company crashed and they were bankrupted. And, you know, these kind of thoughts stay with us, and it's very scary. Now, the thing is, one of really the key principles is to invest for the long term. And that's because although we tend to think that the stock market is a short-term thing, because there is, you know, the prices change every day and it go ups and down, etc. Actually, you know, if you look if you take a long-term perspective and look at the stock market, you know, we see that it's very cyclical, and that on average, in the last 100 years, there has been a stock market crash or decline or correction on average every 3 years. Okay, so every time this happens, there are a lot of people who are like, oh my God, all the journalists, it's a drama because it says, obviously, you know, newspapers, etc. It's sensational. So billions have been wiped out. Retirees have lost billions in pension assets, blah, blah, blah. You know, so we see all these headlines. It's like it's the end of the world every time. But when you're actually a knowledgeable investor, you know that this is actually, you know, business as usual. There is a crash or correction on average every 3 years, just the way it goes, okay? And in spite of these, you know, corrections or declines, the long-term average return per year, you know, if you look statistically by looking at the returns of the stock market in the last 100 years, you always kind of get 9 to 10%, okay? And if you, adjust this, because, you know, 9 to 10% is some kind of pure return, but then, you know, we have to account for the fees we pay, for taxes, for inflation, etc. So if we look, from kind of our perspective, we always get the return on average are always kind of 6 and 6.5% per year. And that even when there is a crash on average every 3 years, okay? And so once you know that, you're like, okay, so why do the crash really matter? The crashes don't really matter if on average you still get the same. And this 9 to 10% or 6% for us, you know, it's valid if you look in the last 20 years on average, in the last 30 years, in the last 50 years, in the last 100 years. Or in the last 30 years, or the 30 years before that, or the 30 years before that. It's very surprising how the world is changing, and yet the average stock market return for the long term, they stay very, very consistent, okay? All right, and then this is why I invite you to, you know, look at risk, the risk of investing in terms of time, right? Because when you invest for less than 5 years, the chances you're going to be on the wrong side of a stock market cycle is very high. But if you invest for 10 years or plus, you're way past the cyclicality things. And then most of the risk of the stock market are basically eliminated because, you know, you're past the cyclicality. All right. So really, I encourage you to think about risk, because often we are like, oh, I want to invest, but I don't want to take any risks. But risk is not about how you feel about risk, it's more about time. How much time do you have? Okay. So that was one point I wanted to make. And the best way to minimize risk is to invest for the long term being 10 years and ideally much more than that. Now let's look at rule number 2. Invest for at least 10 years. So see, there is really something about this 10 years hurdle to benefit from compounding. So let's look at this topic. So what might be holding you back? It's to think, and this happens to me as well, you know, it's very human, is to think now is not the right time to invest because the stock market is too high. I'm changing job. I'm getting married. I'm getting divorced. I'm buying an apartment. I'm moving to another country. I'm getting a child. There's always some kind of reason why we think now is not the right time. I will do it later when I have time later. Okay. Now, this is a problem because when we delay investing, we're missing out big time on the magic of compounding, and we think we can catch up, but actually we can't. So first, let's look at what compounding means. So it means that it's a mathematical formula. You guys are all techies, so that should be easy to understand. Is that you get a return on the amount you initially invested, but also on the accumulated earnings of previous periods. Okay, so to illustrate that simply, think of it this way. Let's say now you invest, I don't know, £10,000. And then a year from now, you will have received dividends on that money. That won't be much because dividends nowadays, it's not, you don't get much. So you will get a dividend, and this will be automatically reinvested. And the year after that, you will get a dividend on the money you invested, the 10,000, but then you will also get a dividend on the dividend you got the year before. And then the year after that, you start getting a dividend on the dividend of the dividend, etc. And so the first few years, this is peanuts, doesn't look like anything, but after 10 years, the returns really start accelerating. So it looks like this. If we have this, let's take this example. Scenario, you start investing with €5,000. I mean, it could be 50,000 or more or whatever, but let's keep it simple. And then you invest €100 per month for 40 years. Okay. So, obviously it's not a straight line like this. It's more like up, down, up, down. These are average returns here of 6.5%. But as you can see, on average, the difference between saving money and investing it before 10 years is negligible, right? Except it's going up and down and up and down. And a lot of people, they panic when the investments, when there is a crash, and then they sell at a loss, or they wait until it recovers and then they sell and they're like, oh, at least I didn't lose anything, okay? But then that means that they give up way too early and they don't have a chance to have the compounding formula work for them. And as you can see, the longer you invest, the more, the faster your portfolio grows and your return accelerates because of this compounding formula. When you invest for like 80 years, it's like going straight up. It's something crazy, okay? And so I want to also talk about Roberta, the worst investor in the world. Over 40 years of investing, she managed to only invest right before a stock market crash. So this is not a real story. It's, at some point, someone had calculated what would have happened if someone had invested always at the worst possible time in the stock market. Okay, so she starts when she's 22 years old. She invests everything she has in the S&P 500, which are basically the 500 largest companies listed in the US. And these index, or this portfolio, if you want, is often used as a proxy to reflect or calculate average stock market returns. Anyway, she invests in a portfolio which includes these 500 companies. And it's the worst possible moment. Right after that, there is a market crash, big time, and the portfolio loses 50% of the value. And she was like, oh my God, what was I thinking? This was like the worst idea ever. And she stops investing, but she doesn't sell anything. And then 15 years later, when she's 37, she says, okay, you know what? I'm going to give it another try. And she invests everything she has saved, 46,000. And right after that, there is a crash by 30%. And then again, when she's 49, and then again, when she's 57. So always the worst timing. And she invested in total 184,000 at the worst possible moment. And yet she retired in 2013 with 1.1 million. Okay, so I want you to look at that. She invests at the worst possible times, 184,000, and she retires with 1.1 million. So this is to illustrate that if we go back to, this one. Now is not the right time to invest because the stock market is too high, okay? we often think that. Even I have to kind of like force myself not to think that, okay? Because, it's not about looking for the right time. It's about being invested, having invested for as long as possible in a well-diversified portfolio, so that the compounding formula can work for us for as long as possible in our lifetime, or at least until retirement. Okay, so this is the point. It's not picking the right moment. It's really being invested and getting compounding working for you. And that's, because if you pick the right time, you're trying to be lucky, This usually doesn't work so well. If you're going for this, investing for the long term and having compounding work for you, well, this is a mathematical certainty. Well, I don't like the word certainty when it comes to investing, but it's a your projections are based on math, not on just hoping to invest at the right time, kind of strategy. All right. So now let's look at something else. I just want to check what time it is. See if, okay. All right. So rule number 3, keep fees low, because this works. This works. This is how it works. It's math, but it works. It only works well if you have low fees, when you invest. And let's look at that. So what might be holding you back on that topic is to think like, 2% in fees, 1%, 0.5%, it's insignificant. I don't even think about it. I don't even look at it. Or to think, my money is safer with a renowned bank, even if they charge more. And it's okay for banks to charge fees because they are specialists and I know nothing about investing. Okay. So now I have my last poll. So it would be great if you could, participate. And basically it's, in asking for all the people who already invest, it would be great if you could indicate in what exactly you invest. So we should have the poll, which will magically pop up, hopefully. Sophie, at least I don't see it for some reason. Okay, there it is. So take a few seconds to vote in the poll, and then we will look at what you guys are investing in and take it from there. All right. Take a zip in the meantime. Perfect. So we're gonna now end the poll, look at the results. Okay, so we have a majority of people, about 50% of those who invest on a trading platform. This is good. Obviously, then you have to make sure you're investing in the right stuff, but this is already a good starting point. Then invest in a savings plan. So that, again, usually it's good. You just have to make sure the fees are, are affordable, and that what you're investing in actually is a fund or an ETF that has low cost. Okay. Then we have invest in some kind of funds from a bank. This is usually very expensive. I invest through an insurance policy. This is usually terrible, actually. And I invest through a robo-advisor. A few of you do that. Okay, perfect. All right, so thanks for sharing that. Let's get going. Okay, so fees really matter. 0.5%, 2%, 1%, whatever it is in the fine print. Doesn't seem or sound like a lot, but it will eat up to half your money or more if you invest with an insurance company over several decades. So now let's look at the examples we had before. And we see, the example I had taken is when you invest in an ETF with a fee of 0.2%. And if you look at, if you take a fund from a regular bank, which actually they tell you they charge 1.5%. And here, I actually need to adjust that chart because at some point for the participants in my paid program, we did a case study one of the students got an offer which looked really great to invest in a sustainable fund from a UBS here, bank in Switzerland. And I asked for the documentation. I had to ask for extra documentation they hadn't provided. We had to really dig. I had to dig to find all the fees, and not even all the fees were properly disclosed. And at the end of the day, what they were saying, they are advertising as they charge 1.5%. In total, they were charging 3.7%. Okay, with all the fees here and there. Okay, so that's why when you invest with the traditional banks, they are very fee hungry. They put fees everywhere, which basically means your money cannot grow, as you can see here. If we look at investing with a kind of life insurance policy where you are covering the risk in case you die or becomes invalid, but if you don't, when in 20 years or 30 years or whenever, at the end of the policy, you get some money back. These are the worst kind of investments that typically have fees of 4.5% on average. And so, as you can see, your money can barely grow. Okay. All right. And so there are two ways to lower the cost. One is to invest in low-cost investment products like ETFs, for example. And the other way is to choose low-cost providers like low-cost online trading platforms or like low-cost robo-advisors, etc. And to avoid kind of the traditional financial institutions, the traditional banks, and then the traditional insurance companies, life insurance policies. All right, so now I want to spend a few more times on ETF, because this is a word you might have already heard. It's often, it's all over, but sometimes a bit difficult to understand what it actually is. So an ETF is actually a fund, a low-cost fund, and it's a portfolio that is constructed to include, the portfolio is constructed to include the components of a market index. Okay, so I took the example before of the S&P 500. That's a market index which represents the 5 largest companies listed in the stock market in the US. And so the portfolio of an ETF that tracks the S&P 500 is automatically invested to reflect the composition of this index. And because nobody is kind of analyzing these companies, analyzing the stock market and the movements and whatever, no, there is none of this. You just invested in these 500 companies. That's it, and it's automatic, okay? Because of that, it's a low-cost investment because there is no need for research, for portfolio managers, for trading team, for whatever, okay? And so the striking things about ETFs is that study after study after study shows that actually, and that's very counterintuitive, ETFs generate a higher performance than traditional active investments, or and by that you can understand the funds that are sold to you by banks and traditional financial institutions. Okay, and it's kind of counterintuitive because you're like, yeah, but they're analyzing, they're saying, we're monitoring the risk, and when the stock market goes down, we sell the share, and we have some kind of hedging for interest rates and currency and whatever fancy stuff they talk about, and that they do. They are actually the performance, and that's one piece of research after the other demonstrating that actually their performance is lower. And the reason is that to do all these things, the hedging, the research, the analysis, whatever, it costs a lot of money and manpower. So they charge a high fee for this to your investments. And the reality is that they are unable to generate added return to compensate for the fees that they charge. Basically, that's at the end of the day. Okay. And so let's look at a real life example. In 2015, I invested in a 3A pillar. So this is some kind of Aysha accounts that we have here in Switzerland at UBS. And I just wanted to save on taxes because I can deduct it from my taxes. So I did that. I had my bank accounts there. I didn't think so much of it. And then 3 years later, I transferred that money to a low-cost 3A pillar. So think again, Aysha type of accounts that you have in the UK. And then over the 3 years, it stayed at UBS, the traditional bank. In total, so not per year, in total, I had a total return of 1.5%. And then on the low-cost platform, in 3 years, I have the total return of 34.71%. Okay, and these 6 years were actually all very good years for the stock market. Okay, and now it's not completely comparable, it's not statistically relevant or anything, but it's just to illustrate when you invest your money in a fund and in an environment where the fees are high, and that was really the case here. It doesn't matter what's happening if the stock market goes up that much. The fees really eat the return and your money can barely grow. Okay. All right, so how can you get started as soon as possible? Because often you're like, oh, I want to do this. I understand it's important, but I don't know where to start. I don't have time to start and manage my investment, or I'm told I don't have enough money, although I don't think it's the case for you guys. So one way you can start very quickly and very easily is to invest with an online robo-advisor, which are basically sometimes a little bit kind of strange to hear these words, online and robo. We tend to think, but shouldn't I put my money with a renowned bank? Like, what about robo and online? So this, sometimes we have these thoughts, but actually what an online robo-advisor do is an automated way for you to invest in ETFs, and they basically open a bank account for you at a regular bank, and the bank account is in your name, and then the robot is just telling the bank how to invest your money basically in ETFs. All right. So how does it work? You open an account online, you fill in the online questionnaire, you are the minimum needed, you can choose a little bit of your strategy, of your preferences, and then you can schedule automatic transfers from your salary account to this investment account that you have. And then when the money gets there, it gets automatically invested in a portfolio of ETFs. All right, so is it safe to invest online? Again, like I said, it's not, the money is not online, it's actually in a bank account at a regular bank, and the bank account is in your name. And here are a few of them. So in the UK, we have here, we have Nutmeg, we have ETF-Matic. There are a few more, but I just picked a few here. In Germany, for example, you have Querian. In Germany and in Switzerland, we have YouGov, which is specialized in sustainable investing. In the Netherlands, there is Peaks, etc. So I also want to say, I'm not affiliated with any of them in any ways. I don't get commissions or referral fees or whatever, or affiliate marketing or anything. So I just wanted to clarify that. And there are many more, and they're all a little bit similar, but a little bit different. They're in different languages, based in different countries. They have different minimums, different fees. They are kind of all a bit similar, but a bit different. They work for different kind of people. And then in my paid program, I have a complete analysis of 40 of the best platforms in Europe, and with all the details, and all the fees, all the everything. Do they take Americans, etc., etc. All right, so we're almost there. Quick recap: invest for at least 10 years to minimize the risks and grow your money. Minimize fees through low-cost investing like ETFs, and going and choosing low-cost platforms and providers. And the easiest and fastest way to start is with an online robo-advisor. All right, so now I would like you to imagine how you would feel 3 months from now if you would have tackled that topic, organized your savings, organized your whole financial setup, looked at your taxes, looked at your pension contributions, looked at your existing company shares and decided what to do with that, if you need to do something, if you need to diversify, etc. And how you would feel 3 months after having, from now, if you would kind of, tackle that topic and put order into your financial life. Now, obviously, there is a bit more to know about investing. You know, what about different types of investments, bonds, shares, real estate, gold, crypto, etc. When and how to diversify your company shares. I highlighted it because I know it's very relevant for you guys. How to calculate what you will need once you retire. You know, how to calculate when can you retire? Can you retire early? How much will you need? How much do you need to retire early? Okay. And what does that mean that you need to invest now based on when you want to retire and based on how much you want to have from your portfolio when you retire? How to invest directly by yourself on a trading platform? Should you do that? And if so, in which ETFs should you invest? There are thousands of them. They have very cryptic names and they kind of look all the same, but not quite. And it's very hard to kind of understand what are the differences. Which platform should you choose? How to manage different currencies? Should you invest in GBP, in Euro, in USD? Does it matter? No, that's actually this topic of currency is quite fishy, and that's often where you lose a lot in fees, conversion fees, without even noticing. So it's something to really look at. How and when to review or adjust your portfolio as you get older. What if you move to another country? What if you came from another country? What about pension-related investment, missing contributions, etc.? How to invest for kids, etc., etc. So there are a few more topics to look at, obviously, that are of relevance when you want to invest and make the most of your savings. And so if you want to stay with this topic, I would like to invite you to join. I have a book club. It's free. It's a book club where we, every 2 months, we gather online, a bit like this on Zoom, actually, to discuss books that are very relevant about investing and money. So, for example, here, a very good book, highly recommend. We had Millionaire Expat by Andrew Hallam. We have, you know, something also, some themes that are more like for, you know, women are worth it, and also kind of looking at aspects of what should women look at, which are a bit different from, you know, a man's perspective. So if you, I think Sophie is sharing the links in the chat. If you want to join, you're very welcome to, you know, and then you will start, you know, getting a few emails inviting you to the different events, etc., etc. All right. I also have, as I mentioned, a paid program where I cover basically everything that's here and more items. And it's a comprehensive program. It's in English only. It's tailored for expats, for European residents who have kind of an international flair. And I have a waiting list for this. I think Sophie is also going to put the link in the chat if you have any interest. And I must say, actually, I am raising the price of the program at the end of January. In a couple of days, we will open it to people who are on the waiting list, because we want to give people who are interested a chance to join at the current price. So if you have any interest, make sure to get on the waiting list, and then you're going to get information by email from me in a couple of days, and then you will see if it, you know, will be helpful to you. So that was that for me. I would like to thank you very much for your time and attention, and I would love to take a few questions.
Thank you, Aysha. That was really great. I think it's given us a really great basis of where to start investing. And thank you for sharing all of your knowledge and experiences with us.
You're very welcome.
So we've got lots of questions. So I think I'll dive straight in to get through as many as possible.
Sure.
So the first one is, how did you make an investment plan? How do you figure out your financial needs? And did you go to a professional advisor?
Well, I am kind of a professional advisor myself. So I did my own, right? But basically, how you do it. So you look at all the aspects, right? And I think one of the key one is basically looking where you stand now. How much do you have? What's kind of what we say your net worth? So what are your savings? What is your pension that you have accumulated? What are your current investments? Do you own your apartment? Do you have company shares? You know, you look at all the aspects so that you know where you stand now. Then you look at, you know, what you can expect from the pension system based on, you know, but again, you have to look at, you know, where did you live? Are you going to be entitled to anything if you lived abroad, etc.? And then from there, you kind of decide, okay, so I see I can expect reasonably, and we have to be very conservative because things change, so not to have any bad surprise, really conservatively, okay, I can expect I'll get that much from the retirement system when I retire, and I want to have for my living expense that much. And then of course we need to calculate, what about inflation, take into consideration these kind of things, taxes, because you still pay taxes when you retire. And so I have actually a calculator where you plug in the stuff, how old are you now? When do you want to retire? How much you can expect from the pension system? How much do you want on top of that for your lifestyle, etc. And then you get to a figure that says, okay, so basically it means you should invest that much now, right? And sometimes, we have like these ideas, oh, I want to retire early. Everyone wants to retire early. But then, when people go through these exercises, this exercise and these calculators, sometimes they see, if you want to retire early like you plan, you need to invest 12,000 per month now until that time, right? So you see kind of sometimes not really realistic. So you have to kind of adjust your expectations, but at least you know where you stand and you know where you're going. And it's not like most of us, we are like complete in the dark, like, yeah, I make good money now. Yeah, I have some savings, but actually it's complete black box for the future.
Thank you. So I'll dive straight on to the next. This goes against some of the things that you said in your presentation, but I'd be interested to hear your answer. Is there a smart way of investing for medium term, so 5 to 10 years? Samantha is looking to invest partly with a view of buying a next property, but the rates on savings are at the moment are low. So is there a kind of a smart in between step?
So I usually say if you invest for at least if you have at least 5 years as a horizon, then it's worth investing. Then you should do it in a balanced portfolio. But anything less than 5 years, don't bother. Honestly, don't bother. Now, obviously, you could say, you know what, I'm going to take a bit of my money and I'm going to invest in crypto because, it's cool and it's going to go up. Okay, but you're not doing that with like most of your money, which you need for retirement. You're doing that with a reasonable amount that you're kind of using as you kind of play money, right?
Got it. Thank you. So Kim asks, I'm in my mid-40s and I feel like I've missed out. Is there still a way to invest and get good returns? I'm sure there is.
Yeah, so that's the thing, I said in the presentation, we cannot catch up. We think we can catch up, but we cannot catch up. Now, so, it's always the same. If you want more return, you take more risks, right? And I wish there was a kind of a guaranteed way to get more returns, but actually what the research shows is that it's not like that, right? Now, if you invest in crypto and you get lucky and then you make like a killing, well, this is possible, obviously, but it's not a guarantee, okay? And the same, there are a lot of risks involved. And then with the stock market, because the stock market is in a very established way and transparent and regulated and efficient market, as we call it, really saying, I'm going to invest more aggressively and get more return over the long term, that doesn't really work. Okay. But then one thing that I want to say is that 45, obviously you want to start investing where you're like 20, right? But most people actually don't. Most people start thinking about this when they get to 40 or something, because that's when you turn 40, because I turned 40 not so long ago. It's kind of the first time you start looking at retirement, because before it's just so far away, you don't care about it. And so that's when actually most people really start caring about investing and preparing for retirement. And what I want to say is that it's not too late. Of course, it would have been way better starting, the earlier we start, the more compounding we have, the more we can grow the money. But 45 is not too late. You still have 20 years to go before retirement, depending on how much you already have. Maybe you already have company shares, which have grown in value. So this might just, work out well. And another thing I want to say is that we tend to think that, I invest And when I retire, I'm going to sell all my portfolio and I'm going to, live out of this money. Whereas actually, it's not exactly how it works. Is that you're going to stay invested for pretty much your entire life until you die, except there are some formulas which I teach in my program that you can calculate how much you can safely withdraw every month or every year from your portfolio, and then have it continue to work for you while you can use, part of it for your living expenses.
Thank you.
You're welcome.
So let's try and get 2 more in before we reach the end of our time. This question comes from Natalie. What's the recommended number of different stocks / ETFs you should invest in so that it's diversified, but you're not spread too thin?
Okay, so as few as possible. And that sounds strange, but let me explain. So first of all, stay away from shares. Okay, now, if you have company shares because you work there, this is different. Most of the time you're receiving them as bonus or for free, so you want that, obviously. Okay, but what I'm saying is that if you want, when you diversify, you want a diversified portfolio. So investing in single shares, by definition, is going to be very, very hard for you to create a diversified portfolio. Okay, and then if you do, then it's very hard to manage it, to keep it balanced, because things are moving all the time. So you kind of always have to make adjustments and everything, and it's a bit of a nightmare. So to have a balanced portfolio, you're much better off with an ETF. And there are now ETFs that do kind of, you could have one ETF, which is an all-world ETF, so you have the, you don't have all the companies in the world, but you have, all the major companies in all the regions in the world, and they are proportionally represented. You have more in the US because there are more of them in the US. You have Europe, you have Japan, you have emerging markets and everything. You could have all of these represented and nicely managed in all-in-one ETF. And then you could have another one for bonds. So basically, essentially, you would have 2 ETFs. And with that, you would have a perfectly diversified portfolio, because in an all-world ETF, you could have 2,000 shares represented on that, or maybe even 4,000 shares, So you don't need to have more. Now, depending if, for example, I have an ETF, I invest in a gender equal ETF. So it's companies, it's 150 companies that score very well in terms of gender equality criteria. And so it's really important to me, and I want to keep that. So, or you could decide, oh, you know what, I'm from China and I want to have more exposure to China. So I take also, in addition, China ETF, or another country or whatever. But in general, I would say as few as possible, so that your portfolio is very straightforward and easy to manage. And we think we need to overcomplicate it, but it's the opposite, actually. The more simpler it is, the more you will invest in it, the more easy it's to manage, and the more it will grow.
Thank you, that's clear. So we are over time, but this question has been asked a couple of times. So let's just make this our last.
Sure.
How do you decide between investing in a pension and personal investments?
Okay. So you have to look at the rules in your country, and that's really, country specific. The good thing with pension investments, and by that, I mean, I understand contributing extra to your pension fund. The good thing is that it's usually tax deductible. Now, you have to look at something else. I mean, at a few other items. The first one is, how is the money invested and what do you get out of it? So I'm not 100% sure how it works in the UK, but I know that, for example, here in Switzerland, we cannot choose how the money invested, and it's invested in very expensive, whatever funds is not so well managed, and the returns are quite low. And then on top of that, the return the pension fund makes, it doesn't come to me. The return they make on my money doesn't come to me. They only distribute me 0.5% or 1% on a good year. So basically, my pension money is growing by 1% per year. Okay. Whereas if I invest privately, I cannot deduct from my taxes. However, the returns are much higher. On average 6%, in the last few years a lot more, like 20, 30% per year, etc. And so if you take this average of 6.5%, after about 6 years, depending on your tax rate, obviously, here in Switzerland, for me, if I calculate after 6 years, I have caught up with the tax deduction that I didn't get compared to have, if I would have, made an extra contribution in the pension fund. And so what I usually recommend, and I know I talk a lot, so I hope you guys can bear with me, but let me finish on that. What I usually recommend is it's better to invest on your own account. Now, again, you have to see, how it works in your country, and then actually make extra contributions to the pension fund towards the end when you get a big tax break and your money doesn't get stuck so long in the pension fund at a low return because you're close to retirement, and then you start getting it, and then it's kind of like the end of the story.
Got it. Thank you for answering that one. And I think with that, we are over time, so we should close. So on behalf of Women at Tech, thank you so much, Aysha, for coming today and sharing all of these insights with our community.
You're welcome.
And thank you everyone for joining. We hope you found it a useful session.
Sounds good. And feel free to join the book club or get on the waiting list if you want to learn more. And I hope to see you inside the book club. That would be great.
I think I'll be signing up. I think I need to learn more still.
Sounds good. Looking forward to having you in there, Sophie. All right. So thank you.
Thanks, everyone.
Have a good afternoon. Bye-bye.
Bye.